My client does not want to buy any BlackRock, iShare, State Street, or any major Canadian bank's ETF. In this video, I'm going to explain how I build a portfolio for a client of mine who is a retired person and does not want to buy any major Canadian or US bank's ETF and only wants to build portfolio with lesser known brands like Global X, and what was the rationale behind those idea and how I came up with the portfolio to match his requirement. If you are new to this channel, my name is Ahmed Mahiyan and I'm an associate portfolio manager. Recently, we met with a couple who are over 70 years old. The husband used to be a project manager and the wife used to be a homemaker. They're dealing with an independent investment advisor at one of the largest Canadian financial institutions. They specifically came to us because we heavily focused on financial and tax planning. So when we met clients after going through all the financial plan, we determined that they have far more money to spend compared to their expected expense. We found out some tax planning opportunity because they were preparing their tax return by themselves and did not optimize the tax return properly. But it's not a big deal and it's not out of the ordinary. We tweaked and we just gave them some direction what to do the next tax year. But basically, the major requirement they had is to build a portfolio that has some following restriction. So the number one restriction that they have is not buying any ETF that is from BlackRock, iShare, or Vanguard, or any major Canadian banks. This couple believe these major corporations have too much power. This is giving the corporate America the upper hand so they can fund those companies that do not align with this couple's view. They also are very Catholic-minded religious persons, and a lot of their fund goes to registered charity like different churches and different organizations. Now, in our standard portfolio, we typically use Vanguard, iShares, and different large financial institutions ETF because in most of those categories that we invest, these are the ETFs that provides the lowest investment management fees while they track that index pretty closely. So we like these ETF just because they provide what we are looking for with a very reasonable cost. We do not invest in individual stocks because it moves so much in a particular day, and it's very difficult to build a portfolio unless you are following the market very closely. Most people do not want to do that and is very happy with ETF portfolios. Now, in this particular case, I had to start it from scratch because I cannot invest in any of these major banks. So none of these ETFs that we have been using is applicable to this couple. The next phase of the research was to figure out a trigger point. So basically, I excluded any company or major financial institution that is managing over $500 billion. So this excludes most of the major Canadian banks, any US large institution like State Street, Vanguard, iShare, Franklin Templeton, stuff like that. Then the next phase is to figure out what would be the best ETF or mutual fund in a particular category. Now, when we build a portfolio, our typical portfolio has fixed income portion and international portion, US stocks and Canadian stocks. We often add mid cap and small cap to have a diversified portfolio. So basically, I had to find ETF or mutual fund that is focusing on small cap Canadian company or small cap US companies. Now, the overall portfolio is over $2 million, so that's why we had enough funds for each of these categories. Now, because I cannot invest in major Canadian companies, ETF or mutual fund, I had to look the smaller companies. Now, this is the starting point of my research where I had to use Morningstar advisor platform to rank some of the funds. Now, a lot of advisors typically exclude any ETF or mutual fund that are 1-star or 2-star. Morningstar is a research company that has been in the industry for almost 30, 40 years. Basically, they are a research-driven company where they analyze stocks, ETF, mutual fund, and they rank them based on their different criteria. So if a company or a ETF or mutual fund has high ratings in different criterias, Morningstar will give a 5-star rating. And a company that does not have any of those criteria fulfilled, Morningstar will give a 1-star rating. So basically, 5 is the highest and 1 is the lowest that a company can get. Now, a lot of advisors typically exclude any companies or ETF or mutual fund that is less than 4 stars. Now, if this is the starting point, then we have a universe of ETF or mutual fund to start with. Then the next step is to figure out what would be the best among that particular category. Once I started with 4-star above ETF and mutual fund, my universe pretty much shrank because I had to exclude a lot of the major financial institutions' product. Now, in this stage, a lot of the funds that are coming up was from Global X, AGF Investment, McKinsey Funds, Whittle Goodman, and some other smaller boutique investment firms. So for the Canadian portion of the portfolio, we end up buying Global X, Whittle Goodman, Manulife, and Dynamic Funds. Now, we had to caution our clients that some of these mutual funds that are used to build this portfolio are pretty expensive compared to an ETF portfolio for our regular clients. Since we explain it properly to our clients and explain why we had to make that choice, we had to explain the clients that mutual fund portfolio will always cost more than the ETF portfolio, and they were okay with that because they knew that they gave us a list of restrictions which limits our ability to go for low-cost ETF. Now, on the US side, we had a better choice because the US had a lot of investment options. Since they are devoted Catholic, we were able to buy a Catholic ETF that tracks the S&P 500 and is not from a major financial institution from the US. The clients were very happy with the choice because they could not find any investment option that meets their religious viewpoint. Since most of their funds are in Canadian dollar, we had to make a compromise not to buy any US dollar ETF and stick with the Canadian denominated ETF. Sometimes as an advisor, we give clients instruction to just buy a US denominated ETF in the US, but oftentimes because of the exchange rate situation right now, and we're in a very unattractive exchange rate situation, a lot of our clients tend to hesitate to convert their Canadian dollar into US dollar. So we had to stick with ETF or mutual fund that are Canadian dollar denominated but invest in the US. In this category, we again stick with Global X, Canada Life, and Dynamic Fund to meet our requirement. Again, some of the funds that we recommended are mutual funds and tends to have a higher fees compared to their ETF counterpart. In the international section, we had a little bit of choice, which are a little bit better quality ETF. In the international category, the clients already had some our fund, and we had a choice to go with that or recommend something else. We end up recommending some funds from Brandeis and CI. Now, in the fixed income category, because they are very low risk investor, we had a lot of fixed income that we had to deploy. The challenge was in this category, there are very few companies that are outside of major Canadian banks that are good fixed income fund. So again, we had to make a compromise and we stayed with Whittle Goodman, Global X, and Purpose Investment Funds. For the international market, especially in the US Emerging Bond Fund, we had to make a compromise and stay with the McKinsey funds. So overall, the $2 million portfolio, we had 50% in stocks and 50% in bonds. The client also had large cash position in GIC and similar type of predictable investment in other funds, but we did not include that to our portfolio and we set aside for any liquidity requirement for the next 5 years. So when we add those cash position, the portfolio is actually less than 40% equity, which is pretty appropriate for an investor who has a very low risk profile. So in this example, we analyzed a lot of different funds and we had to make a lot of compromise because of our restrictions. In the end, what really matters is how client is implementing this portfolio. We gave the recommendation to our clients, but it's now up to the advisor and the client to actually implement that portfolio. The client did have some capital gain embedded in their non-registered funds, and we had to make another compromise not to sell them immediately. In order to lower that capital gain tax, we made a recommendation that these large capital gain funds will be donated to different charities to avoid any capital gain. Slowly over time, we will reduce that position and the overall tax burden. Now, throughout the conversation during the financial planning and investment plan, we recommended our clients to increase their spending because if they don't do that, there will be a heavy tax when both of the spouses pass away. So instead of holding cash and investing very conservatively, we recommended to increase the spending and maybe gift away some of the assets to their children while the children still need the funds to buy property or grow their asset base. Now, this is an example of a very unusual case because the client had lots of restriction in their portfolio. This is not very uncommon. An advisor's job is to figure out what client wants and build a portfolio that the client is comfortable with. The current advisor did not pay attention to their requirement and bought a cookie-cutter solution from a dimensional fund. There is nothing wrong with a dimensional fund, but it does not serve the client's purpose. The client specifically wants a fund or a portfolio that is outside of major financial institutions' ETF. Now, if you have a situation like this and your advisor is not willingly to talk to you about your preference, let me know in the comment section. What are the steps you are taking to build a portfolio that meets your requirement? Thank you again for watching this video, and if you like this kind of video, please subscribe to our channel and like this video so the YouTube algorithm will give us a little bit of boost. See you in the next video.